into such investment banking of investment specialists, fixed income researchers, equity researchers, multi-asset researchers, you need to know that what exactly is going upon in the global environment. So that is something you need to be very well versed with. And that is something which I keep on stressing upon my students as well, that you have to focus upon the global market dynamics, what all is happening in the global market. And you need to be very well aware of those dynamics because majority of the questions are being asked upon the global market dynamics. If you guys are appearing for a bank that works multinationally, for an investment bank that works multinationally, like JP Morgan Chase or Company, Goldman Sachs, Morgan Stanley, Citi, HSBC, these banks, they won't be catering to just Indian markets. They will be catering to the markets globally. People who are sitting into such profiles of investment specialists or researchers, they're tracking the global markets. Apart from India, that they are tracking the US markets, Australian markets, Mexican markets, Japanese markets, European markets, different other markets. And they're trying to take certain bets, tactical bets upon the market movements in different economies from equity perspective, from fixed income perspective, from alternatives perspective. And what do I mean by tactical bets? They are taking the positions into different asset classes and further the stocks within those asset classes to make the returns depending upon the market movement. If they feel the global market dynamic is making the banks more favorable, they might become overweight in banks as compared to the benchmark. Or they might become underweight in IT if they feel the IT sector is not performing good or will not perform good up to a specific timeline. Then they might underweight IT as compared to the benchmark. So these kinds of rejects or portfolio rebalancing takes place. Rebalancing and rejecting is the same. That is, we're trying to buy more assets or more stocks like within that particular asset class that might give you more return in future, and selling off those specific asset classes or securities that might make you a loss. So that is the thing that they tend to do in the portfolio creation mechanism. And that is the underweight or the overweight that tend to become over the benchmark. And what do I mean by the benchmark? Benchmark is simply the index. Nifty 50 Sensex in India, S&P or Nasdaq in US, right? FTSE per se in Europe, DAX in the Germany market, right? Your CAC in the France market. There might be different indexes per se. And the main aim of the portfolio manager is to beat that index. And that is why he assigns different weights. For example, if HDFC is having a 20% weightage in Nifty 50, for example, right? Then the weightage in the portfolio might not be 20%. It might be 25% or maybe even 15% also, depending upon the market movements. If he feels, if the portfolio manager feels the HDFC bank can do well, then he might assign a higher weightage as compared to index. So Nifty might be having 20%, but the portfolio has 25% weightage of HDFC Bank. In that case, the portfolio manager is overweight on HDFC Bank. We tend to hear such commentaries on the news channels also that the PM is overweight on HDFC or underweight on ITC, right? So, like just for example, I'm just telling you. So in this case, he believes the bank can perform well, the HDFC bank can perform well, and hence he's overweight upon the HDFC bank as compared to benchmark. And similarly, he can be underweight as well. If he believes that ITC has a weightage of 10% in Nifty, and he believes the ITC might not perform well, he might cut down the weightage of ITC in the actual portfolio. He might just give 5% to that. So that's an underweight call, right? And what's neutral? So neutral is something if 20% HDFC in Nifty, then 20% HDFC in the portfolio also. So that's a neutral call. You might have heard the PM talking about taking such bets, correct? So that is in general, like you guys need to understand. The modules are there for that. I'm trying to revamp up the modules also that you guys are watching on the website. New modules and recordings tend to get added. So watch them continuously. And new things like we are learning upon these sessions also, right? So it's an open forum today. If anyone wants to ask questions upon global markets, about like what's happening in the global markets, which asset class to pick up, whether equity or fixed income or alternatives. Why is equity better than fixed income, or why is the fixed income better than alternatives? Which fixed income, which equity, or like which kind of alternative? How can the macro conditions impact these kinds of asset classes? And there can be like multiple questions in the minds of the people joined in this call. So I'll be happy to take up questions. So just starting up with the question, does anyone has any question regarding the global market environment?
Hi, Maurya. So basically, when I talk to my friends in the UK, they say that the economy is not doing that great, but it's fine. It's not like recession type, but it's fine. The job market there. But still, I
Mhm,
mean, the like Nifty or their FTSE, whatever index is there, that's
mhm,
performing great. And similarly, the gold is also going on a, is like is touching higher and higher levels, gold, silver, metals, and all the equity. So does that mean like there is sometime this is all because of election in the global on the global level, or is it because the economy is doing well?
hmm. So that's a good question. See, basically, what's happening? The European markets are something that are trying to outperform the various other markets. So that is something that the European market is trying to do. Because if we talk about the companies in European markets, how does the economy grow? Like be it like any kind of economy, be it India, be it US, be it Europe, is driven by the earnings of the corporates. So like if we talk about the corporates in that market, like in that particular market, if we try to talk about the European market, the companies in that particular market are really doing well. The profits are shooting up, the revenues are shooting up, the cash flows are increasing, right? And even the growth prospectus of those particular companies are doing really well, especially the financial sector. So that is one thing. Also, if we talk about inflation, because when will the Fed reduce the interest rate? When the rate of inflation comes down. In US, the rate of inflation is still high. As we saw the previous numbers, like released day before yesterday, the number we saw as 3.8% or like 3.7%, and that was like 0.1% higher than the previous month. But in Europe, the rate of inflation is coming down steadily. That is below 3%. So that is again aiding the European markets. And like what basically happens, the global balance is first the Fed reduces the rate of interest, and after that the other economies tend to reduce the rate of interest. But what is the expectation from the European markets? It doesn't want to follow Fed. It says that I will bring in my own monetary policy. The country doesn't want to follow US, and hence the rate of interest might come down even before the US Fed makes the rate of interest low. So that is one thing. The European markets are very confident about their economy. The government, the European Central Bank, as we call them as ECB, is very confident about their economy. And they want to reduce the rate of interest because the rate of inflation is coming down, at least on some numbers, on some parameters. The companies are doing really good. The companies are outperforming the other global economies as well. And hence, most of the portfolio managers or investment specialists are taking a positive bet in the European markets because the sentiment is very positive. They are becoming overweight in this market as compared to the other markets. And here I'm talking about the comparison with the developed markets only, be it Russia, be it Australia, be it US. So in that case, the PMs, the portfolio managers, investment specialists, strategists, the global strategists are becoming overweight in the European markets because of all these reasons. The PMI numbers are good. The PMI numbers and like if we talk about the production capacities, expenditures, capex, everything is going really good in Europe currently. And also the dependency on Russia is also going down upon certain commodities being imported, be it oil, be it natural gas, because they're trying to import it now indirectly from India and different other countries because India is being importing a lot from Russia at a lower price. And hence the dependency upon a high cost import from Russia because of the Russia-Ukraine war and kind of sanctions being imposed on Russia is also going down. And if we talk about gold, so gold is something as we have saw the prices is going up. Like even in India, we saw like 68,000 per 10 grams to like 72,000 per 10 grams in just a matter of 1 week. and gold giving 13% return in 2023. And even YTD, the return of gold is around 6 to 7% per se, not in dollar terms. In dollar terms, the return might be lower because the INR, it tends to depreciate against the USD. But the thing is, ideally, what happens? Gold prices are driven by various other sentiments also. Because what basically happens till previous, I would say, till before 2022 per se, or like before 2023, the Western economies, the US especially, was a buyer of gold, right? Was someone that used to buy a lot of gold, maybe to hedge their currency also and to keep it at reserves, right? But over the previous years, we have also seen the rising yields in the economy. In US, the rate of interest rose by more than 550 basis points in one single year in 2023. And whenever the rate of interest rises, people tend to purchase the US dollar. And how can they purchase the US dollar? They tend to purchase the USD when they can buy the fixed income securities, the US Treasury bonds, 2 years, 5 years, 10 years, 30 years. And we have always seen a negative correlation between the yields and gold. When the yield rises, the price of gold falls. When the yield falls, the price of gold rises. So in that case, the people were demanding more of the fixed income securities because the yield was higher and the gold was low. And when people are not demanding gold, the price of the gold should come down ideally, and that we have seen in the previous time. And as this equation of the demand and supply also works upon. But in the previous year, in the recent time, this negative correlation has not perfectly worked. If the yields have risen, if the people have been demanding the more of the fixed income securities, even the price of gold has also increased at the same pace. Why? Because we have China here. China's real estate market has completely collapsed. The real estate market in China, it used to contribute around 8 to 9% of their GDP, and 8 to 9% is a very huge number. Not even a single sector in China contributes more than 5 to 6% as a percentage of GDP, because there are multiple sectors. So we just talk about the main sectors, but apart from those sectors, different economies have multiple hundreds of sectors which have a certain proportion to their economy. The maximum percentage of GDP, or the maximum income, or the maximum kind of a gain which people used to make in China was on account of the real estate properties. Now the market has completely collapsed, right? And even the interest rates in China are going down. Why? Why is China working in the opposite direction? Because they want to increase the demand of the people, because there was a complete crackdown in China. The businesses lost, the people lost their jobs, and like COVID was one thing. And all the businesses, kind of the rules and regulations of the business got shifted. And China was a completely crackdown economy. बिल्कुल मैं बोलूंगा कि बर्बाद हो गई थी economy, right? So in that case, like whenever there is a fear, the interest rates are going down, the economy is not doing well, then people also tend to buy gold as a fear of recession, because like whenever there's a fear of recession, people also tend to buy gold. Though recession is a very hard word, but when the economy is completely destroyed, the central banks, they either reduce the interest rate, the public bank of China, as we call it, and the people tend to buy gold because gold tends to be a safe haven, and gold is also a hedge against inflation per se. So now the Chinese have completely, they have tried to buy gold in huge quantity. Billions and billions of golds have been bought, and that is also increasing the price of gold in the global market. So it's not because the global environment is doing really well and people are purchasing the gold. It's more of on because of China, because the demand from gold from China has increased, because gold tends to be a safe haven, a hedge against inflation. When the economy is completely destroyed, gold tends to preserve the value of your currency, the Chinese RMB, right? And that impacts the global market because the demand is high. And as a result, that gets transferred, and there is always a contagion effect upon the other economies also. So that is why the price of gold has risen, and the main reason is on account of China. Clear, Charisha?
Yeah, so you were saying that one, it's not just the pre-election rally, the economy is doing good. There could be a soft landing. and the equities market is doing good, and the debt market, or the not the debt, I mean the gold market is doing good because of the China coming into picture, China and the Russia Ukraine war and all of that.
Correct. Because China is a
Okay.
major buyer, and also some cases because like we have been seeing two wars currently. Like one is the Russia-Ukraine war, and one is your Iran-Israel war. So these two wars are also creating these situations of uncertainty, and people are buying in gold. Ideally, they should be buying dollar because the interest rates are still high. But there is always an expectation that the Fed will start reducing the interest rate from June. So since these rates of interest have to come down, that they are more like preferring to purchase gold instead of the fixed income securities. So that can be like one aspect of looking into it. Hence,
In that one question, like let's say the people buy bond over there because dollar does good. So if they are buying bonds, that is 10-year security, or let's say 2-year securities, that time the bond prices rise and the yields fall. I mean, price and yield is inversely proportional, right?
correct.
Okay, got it.
And that
Yeah,
happens over a long-term basis, right? It's not only about the Fed. So like that's an answer for everyone. Like everyone like who has joined the call, like it's an answer to everyone. Like we tend to believe that the Fed reduces the interest rate. The Fed will reduce the interest rate, but that is also impacted by multiple factors. It's also impacted by the growth prospects, about a soft landing prospect, a Goldilocks prospect, about a recession prospect, and also like about the people buying it. And that happens over a long period of time, like maybe 2 years or like 1.5 years per se. Because now, like what is happening, the Fed is expected to reduce the interest rate by June end. And that will also come down. Why? Because in the previous years, people have purchased these short duration bonds because whenever the interest rates are bound to rise, people tend to purchase the short duration bonds. And they have purchased those short duration bonds. The price of the bonds have risen. And now it's time for the yields to come down. So it's not only because of Fed, it's also on account of the supply demand dynamics. Okay. And
got
that
it.
happens over a point of time. It won't happen that if thousands of people have purchased a bond now, the yield will fall by tomorrow. No, there are different macroeconomic factors. Certain quantum of people need to purchase it. The macro should support that, and the yields will come down because even if the Fed is not dictating the yields to come down, there is always a fluctuation in the yield on a per day basis, on a per second basis. And the Fed has not made a public statement for the yields to come down, but still the yields tend to fluctuate by point like 0.02 or like 0.03 on an everyday basis. I'm telling you, right? Because that is also driven by the demand and supply dynamics. That is
So
one
if
thing.
the yields come down, the equity markets would go up, like
Ideally,
because the
that is the
money.
logic. If the yields come down, the markets for equity go up. And that is like we have seen historically, right? But what has happened previously, as per our researchers as well, in the previous times, your fixed income security that gives you yield and equity, they tend to exhibit a negative correlation. Correct. If the yields are rising, then people will tend to purchase fixed income securities and go short upon the equities market. And when the yields are falling, then people will go long in the equity market and sell off the short duration bonds currently, right? And that is a kind of a negative correlation that exhibits. And that is the reason why the multi-asset portfolios, they tend to keep both equities and fixed income in their portfolio. But what has been the problem in the previous 1 year or like 1.5 years, starting from 2022 end or like 2023 beginning, has been a positive correlation between the performance of fixed income and equities, and that has been a 0.4 ka number, and that is creating a lot of trouble for the portfolio managers also because the previous year we have saw equity markets rallying everywhere, giving a very good return. And the fixed income market has also performed well. And traditionally, if the fixed income market performs well, the equity market doesn't perform so well, and vice versa. But in the last year, both the markets have had a positive correlation. The movement has been positive of like 0.4. And that was the trouble which the portfolio managers also faced because whenever we are trying to create a portfolio, we need to keep uncorrelated assets. If you're trying to keep up like correlated assets, then if the market falls, the whole portfolio will fall. And that is the problem that the PMs were facing. And that is why, apart from equities and fixed income, they added the alternatives as private credit, infrastructure funds, venture capitalist funds, pipe funds. So different kinds of alternatives they added to make their portfolio hedge against that correlated downfall of equities and fixed income. Because whenever there is a positive correlation, just make a note of this. So whenever there is a positive correlation between equity and fixed income, the concern is lesser on growth, right? Because the economy is doing really good. The concern is lesser on growth and more on inflation. Because equity market is doing good, fixed income market is doing good, the growth is coming in the economy. The concern is only about inflation, because if the rate of inflation persists, the Fed won't be reducing the interest rate in the economy. And that happens quite rarely, as we are seeing in currently. Like even the correlation is 0.03, 0.02 currently. And that is why the PMs are going towards the alternative assets to hedge the portfolio. So that is something that is going on. And that is why the people in US also, they said instead of a recession, we're going to have a soft landing. That's a non-severe version of recession, because the concern is not about growth. The growth forecasts are changing. Earlier, the forecasts were like 0.5%, 0.6%. And now the GDP forecasts have risen from like 1.5 to 2% because the economy is doing better than expected. Okay,
Yes, got it. Thank you.
no worries. Any more questions about the global economy? If anyone wants to know any more, has like, I would say like any of the doubt, like people tracking the global markets per se, any of the questions. One question which someone asked me quite recently. So that was something on, if you guys know about high yield and investment grade bonds. Anyone knows the difference between the high yield bonds and investment grade bonds? These are types of fixed income security. So it's not just debentures or the traditional fixed income where people are buying off to make returns or to get that yield. There is always types of fixed income instruments where people invest in to get a certain return. Anyone has any idea about the difference between high yield and fixed income? High yield and IG universe, investment grade and high yield. These are two types of fixed income instruments. And where to go for currently. Though we do not talk about the fixed income market more in India, because the fixed income market is very small. Less than 1% of bonds are listed, but now there is a recent news that our fixed income securities are getting listed or getting included in the JP Morgan's bond index by June 2024. And also they will be a part of the Bloomberg index by January 2025. So we might receive more inflows into the fixed income market, and people might talk about more on the fixed income market. That is very important to be talked about in India. People tend to talk about diverse and complex fixed income instruments all over the globe, but not so much in India, and that they need to know. Because once we get included into these indexes of JP Morgan bond index, and of course the Bloomberg index, right? The market for fixed income will become very expanded, broad. And here we need to understand about the different types of fixed income instruments. Investment grade, popularly called as IG, and high yield, which is popularly called as HY, is a very common instrument which even the Indian markets invest into, but rarely talked about. In global markets, especially US, Europe, Australian markets, these are extensively traded. So when we talk about the investment grade universe or the IG fixed income securities, just make a note of this point also. These are top high graded fixed income securities. We all know about the credit ratings, which these rating institutions provide to the fixed income market. AAA, AA, double B, B minus, investment category, prime category, speculative category, junk category, right? Investment grade bonds are the AA or AAA bonds, the best kind of bonds in which people can invest into. And on the vice versa, you have the high yield bonds, which are the risky bonds, having a rating of double B or B minus. So just close to C. high yield bonds. The difference between investment grade bonds and high yield bond is grade bond is a high rating bond and has a lower amount of risk. Since the bond has a lower amount of risk, the yield on that bond is also low. Because we know about the simple funda of finance on market. Higher is the risk, higher is the expected return. And lower is the risk, lower is the expected return. Here, I'm saying expected return and not the actual return. So in this investment grade universe, people are purchasing those bonds because they know the bonds are very secure. And hence, those are the less risky bonds. The yield on the bonds will be low. And when we talk about the high yield bonds having a rating of triple B or close to C, the yield on those bonds would be higher because people are taking more risk in high yield bonds. And hence, their expectation of return also rises because they're taking a position into a risky fixed income instrument. And there is always a debate between the spread of yield between the investment grade and high yield bonds. And what do I mean by the spread? Spread, we all know, is the difference between the yield on high yield security and the yield on investment grade security. If high yield gives you 8% and uh, investment grade gives you 5%, the spread is 8 minus 5, 3%. So the spread between high yield and IG, they always talk about the spread between the high yield and IG because in 90% of the scenarios, high yield will give you a better return than IG because people are taking more risk. But the high yield also comprises the feature of risk. As I told you, there might be some bankrupt companies, some distressed companies that might not give you your money. In that case, if the company gets collapsed and the high yields are not secured by some assets, your money might get lost. But since people want some more returns, PMs, portfolio managers, they tend to take positions in good high yield companies, which can transform, like which can become from high yield to an IG company. The companies which are distressed, but they have the potential to do well. And that is a kind of a rigorous bet after so much research that they tend to do. And they take that position as a high yield instrument because high yield is giving you a better return. And the spread, so like currently, if we talk about the spread between the high yield and your investment grade, if we talk about, slowly and slowly is coming narrow. That is from a 3% difference, it's coming to 1.51%, right? Because what is happening? So the demand is so much high for high yield. And we know about the inverse relationship between the price and the yield. The price of the instrument rises and the yield falls, and people are demanding more of high yield. The price of the high yield fixed income is rising and the yield is falling. And people are selling off the investment grade bonds. That is, the price of investment grade bonds is falling and the yield is rising. Right? It means the spread is compressing, or the difference between the high yield and your investment grade bond is becoming narrower. HY yield minus IG yield. It means it means the yield on the higher demanding asset is coming down. That is, the yield on the HY asset is coming down. But still, it's a very good instrument because still, though the difference is low, but the yield is higher. And whenever the spread is very compressed, right? Whenever the spread is very compressed, it's very easier to try to determine the pricing of these fixed income instruments because the buyers and sellers are there. The bid ask spread is very low. And it is good to like determine the intrinsic value of these fixed income instruments because the risk in the market is low. The volatility in the market is low. Because whenever the volatility or the risk in the market is high, the spreads are wider and not narrower. And whenever the spreads are wider, it's very difficult to calculate the intrinsic value or the fair value price of high yield and IG. But since the spreads are becoming narrower, it's becoming easier to calculate that because the fundamentals and technicals are strong. Correct? But if this yield compresses completely, if the yield compresses completely, then people might start to purchase the IG bonds instead of HY bonds, right? Because if the difference becomes very narrow, then why will people take that additional risk for that 0.5% return or like 1% return if there is a probability the company might default or it's a distressed company. Because in most of the portfolios, people are still overweight on high yield bond. They are purchasing the high yield bonds. But there is a second set of people where they've built a conviction upon the IG universe because the spread is coming down. The yield on the high, sorry, the yield on the high demanding asset is coming down. That is happening. Or the third scenario is they are still buying high yield, but they've also tried to purchase the IG universe, the investment grade universe. So two types of fixed income, which really people talk about, but talked a lot about in the US markets and European markets. And somewhere in between the high yield and IG universe, you have something called as a crossover credit. I've just mentioned this term in the chat box also, crossover credit. It's something between high yield and the IG universe. If the guys are confused that what to purchase, high yield or IG, there's an instrument called as a crossover credit, not in India, very well traded in the European markets, less in US, a crossover credit, a new instrument that is gaining a lot of interest among the PMs. It's somewhere between the IG universe and the high yield. And you have two kinds of stocks here. I've posted a LinkedIn post on this instrument of crossover credit also. It's a fixed income instrument that becomes HY at a point of time and IG at a point of time. So for example, if an investment grade bond has to be downgraded, the company might not be like performing well and the rating of the company has to come down. So if the rating of the company comes down, the rating of the fixed income instrument will also come down. So even before the rating has come down, the price of that IG bond will come down because people are selling off that IG bond. So even before the rating event has taken place, the price of the IG fixed income will come down, right? And the same can also happen with the HY bond. If the upgradation has to take place, right? So even before the upgrade event has taken place, the price of the HY instrument will start to rise because people know that they can purchase it at a lower price because when the rating event occurs, the price of that bond, it might become even higher. So the demand of the HY bond starts to increase. So it provides an instrument somewhere like in between where you guys can take an advantage. If the rating event has to go down, right? Then you can start selling. If the rating has to go down, then you guys can sell off the bonds, right? Before the price goes down, like so that you guys can sell off the bond at a higher price. And if the rating event has to go up, you guys can purchase that high yield bond, which can become an IG per universe, a part of the IG universe at a lower price. So this kind of arbitrage can also take place because it provides a facility of arbitrage between the price distortion at a point of time because the high yield, which can become IG, is trading at a very lower price. So you can buy it and sell it off at a higher price later, even though it doesn't go down to HY later, right? But still, like you'll have a time to make profits. Any questions? Can you please explain how differently emerging market and developed markets might get affected due to any global uncertainty? What all factors will be considered while investing in the various asset classes in such scenarios? So different factors have to be taken into consideration. You have to look at your inflation rate, your PMI numbers, that is the purchasing manager index, about the central bank's expectation of reducing the rate of interest, how the economies are performing, right? How is the valuation of different sectors? Like even if the valuation is high, is the valuation driven by earnings also? If the valuation is not driven by earnings, that might not be a good company or sector. Because like currently we have seen even the higher valuations are being accompanied by good earnings. Even if the company is higher valued, the earnings are supporting that. Like for example, like if you saw the S&P 500, the S&P 500 has given a 10.7% return YTD, year to date basis, out of which around 2.7% is on account of earnings. Some 5% is on account of a multiple expansion, and some 0.4% is on account of dividends, right? So that earnings component is there. So valuation, so like I'll be explaining you these terms later, but the thing is, if the company is trading at an overvalued number, the earnings should support that. If the earnings are not supporting that, the valuation is completely off, then you might consider buying some other stocks, sectors, or taking a bet into some other markets. Right? So that is something. So different factors you have to take into consideration, some geopolitical conditions, some war-like conditions, right? So all these things you have to take into consideration whenever you are investing into a developed market or emerging markets. You have to read into the different commentaries, like which the management of companies are saying, like which the Fed is saying, because all these forecasts will play a different number, because different economies like will be having different growth rates, different rate of inflation, different expectations of the Fed reducing the interest rate, different earnings. Some economies might be overvalued but not supported by earnings. Some economies might be overvalued but supported by earnings. So these things you have to take into consideration. Each and every macro factor you have to take into consideration while you are trying to take a bet upon the particular economy. Equities are bound to do well because the interest rates will come down and the earnings are really good for the companies. Fixed income, people would be purchasing the long duration bonds now because the interest rates are expected to go down. Apart from long duration, they might take certain kind of positions in short duration just to hedge a portfolio if the rates stay higher for longer. They might take some positions in the alternative credit, in private credit, in high yield, in leverage loans. These terms are complex. I'll be explaining you these terms in subsequent sessions. Different types of fixed income asset classes in which you guys can take a position in, right? So all these things can affect the global market. So you have to take into consideration all these parameters, right? Because, sorry, as I told you, fixed income market is very complex. Different asset classes being very complex, right? And different types of instruments can be taken position into fixed income. So I'll be telling about all these fixed incomes, the crossover credit, high yield, IG as we discussed today, about the leverage loans, trading of loans, sovereign credit, private credit, your mortgage-backed securities, your ABS, the automobile pass securities, pass through and non-pass through. Okay, so ultimately everything you have to read on. So these things you have to take in a very well kind of a consideration into, right? So that is something I wanted to